can all hear me. I'm not going to worry about it. So you want me to go to about 9:45? We are in a good mood because you're going to save us some money. Guys, it's going to be pretty obvious when we take a look at the tax rules as to the proper way to set up a real estate agent business. And also, I'm going to give you guys some things that you can take to your clients. Here's a fun one. Do you guys know what a 121 exclusion is?
Oh,
Say that
Heard of
again, you
that?
cut off. What is it?
A 121 exclusion. You guys are probably familiar with being able to deduct or not having to pay tax when somebody sells a house that's their primary residence of 250,000 to 500,000 if they're married filing jointly.
Okay, I just didn't know it was 121.
Yep. So that's called a 121 exclusion. And a lot of people don't realize that you can do a 121 exclusion plus a 1031 exchange on the same property. And so the reason this is important is because if you have a client that has more than $500,000 a gain, and they're married, or if they're more than $250,000 in gain and they're single, the option is to turn it into an investment property for 6 months to a year, and then sell it as a 1031 exchange and avoid tax entirely. So little things like that. There's things you can keep in your pocket so that if you're dealing with somebody that's got $1 million a gain, they've had the house for 15 years, and they're looking at a $300,000 tax bill, and you could avoid it for them. A, they'll really appreciate it, and B, you may get additional sales out of it because now they're actually looking at replacement properties. They're looking at replacement properties. So let's keep jumping through. Just so you guys know, Rudy, thank you for saying nice things about us. At the end of the day, people are kind of like, hey, I want to see how much somebody can actually save me. The way I prove my value is generally by putting monies in people's pockets and by making sure that nobody can take their stuff away. That second half of it, of making sure people can't take your stuff away, may not be nearly as important because you may not see it. In other words, if we put a correct asset protection plan around real estate, people just, you'll never know because you'll avoid the lawsuit entirely. So what ends up happening is we have about guesstimation of somewhere just around 40,000 clients nationwide. We see almost no lawsuits. We went through a 7-year stretch with 0 audits, and I'll show you why that is. Basically, nobody messes with you. It's a way of kind of disappearing if you need to. Now, I know a lot of you guys are just focusing on the real estate, so I'm going to narrow my view on that. But just know that those things are out there. That's how we kind of look at our worth is, hey, I'm putting money in people's pockets. Like Rudy knows, hey, save me 60 grand. Fantastic. I can see an immediate response just by doing a little tax planning. And by the way, everybody, I don't care who you are, whether you're a W-2 employee to whether you have your own S Corp or whether you're an independent contractor, everybody has the ability to do tax planning. It's completely, absolutely a fabrication out there, a complete lie that people can't do tax planning and that they have very few options. There's so much stuff that's out there, whether it be HSAs, retirement plans. There's something called a defined benefit plan, which is the reverse of a defined contribution plan, which is defined contributions like an IRA. Hey, I could put money into a plan. I could put $7,000 a year. Yay, that's going to get me almost nowhere. But I have clients that put more than $1 million a year into their retirement plans per year that's tax deferred. And the reason they're doing that is because we use different rules for them than everybody else is using. And so those things are out there regardless of who you are, and we'll show you how to use them. Me personally, let's see if I can actually advance this. There we go. Me personally, I'm a tax attorney, but I'm a real estate investor. My partner and I, Clint, who Rudy knows most of the folks here. Clint's the one up in Tacoma. He looks like a Ken doll, Rudy. I don't know if you've been able to meet Clint over the years. But he and I own real estate nationwide. We have over 200 pieces. We have commercial, everything from warehouses in Savannah in North Carolina to commercial in Las Vegas and Tacoma, Washington, to single family residences in Oklahoma, Texas, Missouri, Mississippi, Alabama, Indiana, North Carolina, California. We do have some still in the Palm Springs area, and Las Vegas. Just, we like to buy and sell real estate. We pretty much buy it. We accumulate it at this point. But that gives us a little different perspective than most of your, attorneys and accountants out there. They're very knowledgeable, but knowledge gets you only so far. You actually have to know how it applies to what people are doing. The big thing is, it's almost impossible for me to tell you how to be a real estate agent, for example, unless I'm actually in that industry and I'm a real estate agent. So I'm not going to sit here and try to tell you how to sell a house or how to list or how to cultivate leads and things like that I don't do myself. And I see a lot of attorneys and accountants getting into the area of real estate, but they don't own real estate themselves. And it makes it very difficult because there's always going to be a complete disconnection between what they say and what's reality. And that's the problem. And it's what they don't know that gets you in trouble, because they're going to say one thing and, oh yeah, you can do this, that, and the other, but it doesn't actually apply to your industry. And so that's what we do here is we work with people. We actually live, eat, and breathe this stuff. And at the end of the day, we have three simple things. We want to help people preserve their assets. We want to make sure that they're protected from lawyer snoops and Uncle Sam being the one that likes to put his hand in your pocket the most. And then we like to allow you to prosper and grow. And what we find is that if you can keep additional cash flow of 10 to 15% a year, it makes a huge difference. And I'll show you the numbers to show you how big a difference it is. But even $1,000 a year will make a difference between somebody who can retire comfortably versus somebody who's still playing around with Social Security and trying to get some other benefits in order to make a decent living. Just so you get an idea of our firm, there's about 300 of us. We have 3 offices in Las Vegas. We have an office in Cheyenne, Wyoming. We have an office in Tacoma, Washington, that are main offices. We have offices in all 50 states for registered agent. We're able to work nationwide, and this isn't our first trip to the rodeo. We've been at Best Places to Work this year in a nationwide Best Places to Work, and in local Las Vegas area. We were number 9 in the state for medium-sized businesses, which is nice, from the Review Journal. And we've been a firm of the future this year for Intuit. These are all this year. So we have lots of stuff. We've been on the Inc. list. We've been at Best Places to Work on numerous occasions, and Business of the Year here in a local chamber. In other words, we're not brand new, and we take care of our people, we take care of our clients, and we take care of our employees. And going through this last year, that's the big difference between a lot of employers, as I imagine you're seeing it, is they have to be able to take care of themselves and take care of their employees. A lot of people have been hurt by this COVID, and you get to see what people are really made of is whether they take care of their people. What we do, bookkeeping, tax, you name it. If it has to do with small business, we can do it. If somebody needs tax prep done, if somebody needs bookkeeping done, we do it. If you need an entity set up, we'll set up your LLC or your S Corp or your C Corp or your nonprofit, even 401ks. If you want to be self-directed and be able to handle your own investments, all that stuff, we could do it nationwide. Now, I'm just going to give you some tastes, and then we'll dive into some more specifics. But I just want to give you a taste of what we see in the real estate world. And I'm going to give you 3 things that we see that are missed quite often in the real estate world. And it gets pretty interesting. These are the kind of the big benefits that real estate professionals miss. And I'm bringing this up to you guys so you can help your clients, because if you help one person on taxes, I swear to God, just helping Rudy, who you just came through an event with us, right, Rudy? Years ago, you probably just went to an event.
Crystal introduced me to you.
Crystal, all right. So there you go. So Crystal was with Rich Dad, one of their students. And we work with her to help put up a system where she's able to minimize her taxes and put together a structure where she doesn't have to worry about somebody coming and trying to take her personal belongings if something goes wrong with real estate. And I know she was in, without getting into all of her stuff, she was in areas where there was riots and things like that in Missouri, I remember. And you have to worry about these things, right? Well, we took care of her years and years and years ago. And as a result, because we took care of her, she talks to people like Rudy, who then comes here. And then if we save Rudy money, all he has to say is, hey, these guys saved me a bunch of money. That's it. Makes life so much easier. The same thing is true with you. If you have a client and they come in and you know just basic stuff to say, hey, did you know you could do this? And you save them 20 or 30 grand, do you know what they're going to do? They're going to sit there and they're going to tell everybody that they know, hey, get rid of your other agent. These guys know what they're doing. He saved me or she saved me an extra 30 or 40 grand. They're actually studs. They know what they're talking about. Most agents don't touch this. And all of a sudden, boom, you know, you take over and you take on a different dimension entirely. So I'm going to give you 3 things that you could literally be looking for at all times to help people with, because we see it over and over and over again. And it's kind of fun. Number 1, if you're dealing with investors at all, and Rudy, I know you guys do mostly residential and stuff, but have you guys been picking up some investors? Do you have anybody that's picking up properties and is an investor?
Yes, yes. So the way it works here to be, after we help the family to buy their first home, we enroll them into our Clients for Life program. Essentially, it's an investors club. So our job here is not just to sell them homes, to make them rich through investing in real estate.
Perfect. This is going to change their world the way it is right now. And it's going to be this way for another 2 years. And so you have some laws that were passed under the Tax Cut and Jobs Act, CARES Act, that changes the way real estate is treated for a little while. And this is the big one. And I want you to visualize that you're flying into, and we should all go to Orlando right now, right? Everything's open, except maybe, is Disney World open? I don't know if they closed it yet. I think it's still open.
No, they are open.
Yeah, you can go see, so you can go see Mickey. Mickey probably has to wear a mask or something, but.
Yeah, my wife asked me to go to Disney World, and then my mom every day sending me a message how disastrous coronavirus is.
Well, you can say, Mom, she can get the vaccine now and go to Disney World. So, so let's say we go to Orlando, and this is true story. You guys can Google this. You could do your Google Maps. What I'm going to tell you is absolutely God's honest truth. When you go to Orlando Airport and you get a rental car and you start driving to Disney World, all of the signs will take you to Disney World, and they take you onto a tollway, and you hit toll after toll after toll on your way to Disney World. The very first exit when you come out of the airport is something at Sand Lake Road, but now they have a number for it. You get off and there's no tolls whatsoever. It's just you got a few red lights and it runs parallel. So there's a road that you have to pay tolls on the whole time. And it used to be you had to drop quarters into the stupid thing. Nowadays, they just take a snapshot of whatever the number is on your car and they bill you for it, right? But there's a road that goes right next to it that doesn't have any tolls. And that is the tax world, right? You could choose to go the tollway. And if you hear me say, you could either go the tollway or the freeway, right? And I want to go the freeway. In the tax world, those 2 roads really do exist. And nowhere is it more clear than in real estate. So here's an example. I can own real estate. I can depreciate it with generationally multiple times. In other words, I can own real estate. I can never pay tax on it. I can write off that real estate. And then when my kids inherit it, they can write it off again without incurring any tax whatsoever. There's no other asset that's like this. Real estate is it. It's the bomb. But if you don't know that that's what you're giving up when you sell, you might do bad things like gifting it to kids or things like that. You tell people, no, 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 because they get your basis. If we pass away, there's something called a step-up in basis, and then you get to redepreciate it. But it's not just the depreciation. In a depreciation is a fancy way of saying I get a deduction because the value of that house, like I'm going to have to replace it every 27 and a half years if it's residential. If it's commercial or non-residential, it's 39 years. But they let you write everything off. Now, here's a question for you. Let's say that the IRS says, hey, you can write something off over 27 and a half years. So I'm just going to write 27 and a half so you really get it. How long is your carpet going to last? Because they just told you it's going to last 27 and a half years. You guys all know that carpet doesn't last 27 and a half years. Anybody who's into this game at all and is doing investments, you're replacing that carpet probably every 2 to 3 years. If you have rental properties, maybe 5. If you're really, really lucky, you might get 10 years out of it. If you're really lucky, because chances are tenant's going to mess it up, right? They're going to use that thing pretty hard. But the IRS says, no, it's going to last 27 and a half years. You have the choice to get out of that rule and say, I don't want 27 and a half years. I want 5, 7, 15-year property. I want this. And it's called a change of accounting election. In order to do this, you just send an engineer into your house and they break down the components. And so things like your carpet, your fixtures, your light fixtures, your doorknobs, your light switches, the electronics that are running through the walls, some of the plumbing that's in the premises, all of that is going to last 5, 7, or 15 years. And you can choose to treat it that way. Which means if I have let's say I have $1 million house, and let's say that part of it is land value. So let's say 300,000 is land. So I have 700,000. There's a good 200 to 250,000 of it that's going to be here. It's really about 30% of the improvement value, is somewhere in that range. Now, here's what's fun. Right now, under the Tax Cut and Jobs Act, you can write off 100% of that, 100% in year 1. I don't want that to sink in just for a second. Every single one of you guys is a real estate professional. There's no such thing as passive real estate losses for you if you don't want them. You have a simple test of, do you spend more than 50% of your time in the real estate business, in the development, redevelopment, construction, sale, brokering of real estate? And they say brokering, but that means real estate agents too. There's actually a court case on it. All of this stuff means that any losses that you can create, paper losses on your real estate, will go against your W-2 income or your income that you're making as a real estate agent. You just have to materially participate, which you're doing. And then on your real estate, you have to materially participate, which you guys are all going to do anyway. It's almost impossible for you guys not to be a real estate professional. And only one spouse has to qualify. So if I have spouse 1, who's a doctor making $1 million a year, and spouse 2, who's a real estate agent, and we can create $1 million loss from their real estate holdings, even though they're making a ton of money, but we create a paper loss by accelerating our depreciation, we pay 0 in tax. Now, I'm not saying pay 0 in tax, but I'm just giving you guys that an example, right? We still want to have income because we want to be able to borrow money and things like that. We want to be able to grow our business. But that just means that you have a choice. And a lot of people don't realize that they have that choice. And I see it all the time because I run these census all the time on these properties. And I'm like, you realize that you overpaid 70, 80 grand last year. Like, let's go get it back. And by the way, if we create a loss in this, you can carry it back 5 years under the CARES Act. So this year only is going to be our last year. Now, you don't have to make a choice on this now. You can actually make it before you file your tax return. So you actually, like, if we're looking at 2020 and somebody wants to see whether they could benefit from this, you could actually run the numbers and they don't have to make a decision before the end of the year. We could be doing it next year. Somebody asked, is this on your primary residence too? Primary residence is considered personal property, which is non-business property. It doesn't get depreciated. If you turn your primary residence into a rental, like you move out and you make it into a rental, then you can do this with it. The other big example of where we see mistakes is somebody sees this and they're able to get a deduction from the cost segregation, but they don't group it with their other real estate activities. It ends up being really, really, like, this is devastating because you could have one property that you're generating a bunch of loss on and they don't group all the activities and they don't qualify as a real estate professional, or they don't treat it all as one, and you lose some of that benefit. More than likely, it's going to be on whether you qualify as a real estate professional, because technically it's a per property qualification. And without getting into all the details of it, you just have to make a grouping election. Somebody who does real estate knows that. A lot of the accountants that are like the H&R Blocks of the world don't, and they don't make the election, and they're easy pickings. The IRS is taking those guys out all the time.
Quick
And then the
question.
last one, and
Quick
this is a
question.
big one for you guys. Oh, go ahead.
Is there a maximum? Is there a cap of deductions, even if you are a real estate professional when you do your taxes, or no?
No. So the way that it works is passive losses. There's two types of passive activities: real estate investing and a business in which you do not materially participate. So if you're like a silent partner in a pizza parlor or something. Otherwise, then all the other businesses are just called ordinary loss, and there's no limitation. You can carry back ordinary losses 5 years and wipe them out, and then you can carry them forward indefinitely. When people have passive losses, so think of a doctor and they have a bunch of real estate and they create losses on that real estate. The problem that you have is they can't use it against the doctor's income because it's passive loss, and passive losses can only be used against passive income. And there's a couple of exceptions. In real estate professional, you're going to hear this, real estate professional is 469C7. That's in the code. That's one of the exceptions. Once you unlock real estate professional, all of your real estate losses are, even though the income is still considered passive, the losses are considered ordinary. And the best example I can give you is a guy who's sitting in the White House right now. His name is Donald Trump. Donald Trump, if you saw the article in the Wall Street or the, what was it? Was it the Wall Street Journal or New York Times? One of those two.
New York.
New York Times. So they wrote an article about him and how he's avoiding all these taxes. And Donald Trump says, well, I prepaid all my taxes. He didn't prepay. He paid his taxes those years. Then when the recession was going on, the Obama administration passed a law that allowed you to carry back losses 5 years. So they allowed him to carry back losses 5 years. What happened then is Donald Trump was able to make an election to carry back the losses on the Trump Tower and get back the taxes that he had paid before. That law did not exist until they changed the rules. They did that this year under the CARES Act. And they said, hey, anybody who has losses in 2019 or 2020 can carry back their losses 5 years, which means if we did this on a client who has investment property in 2020, we can literally go back to 2015 and apply the loss against their 2015 taxes and get back the money they paid in 2015. If we use up 2015, then we go to 2016. If we use up 2016, then we go to 2017. You guys kind of see what's going on? And we're getting back the money that we paid. That's all they're doing, is they're saying, hey, instead of carrying the losses forward, you can go back and use them against past years. And so Trump did that when the Trump Tower, he cost segregated. I guarantee you that if you looked at his return, what you saw is a loss in 1 year because he put the property into service and they allowed him to carry it back to previous years and get those money back. And so that's the classic example. So if somebody's paying taxes and they're a real estate professional, it's voluntary. It's because they don't own enough real estate. And that's what we always kind of joke about. It's like, if you're a real estate professional and you want to pay, taxes are voluntary, because all we have to do is buy more real estate. And if we buy more real estate, we can depreciate it. So you lever it, you get as much property as you possibly can. We write it off and you can see how much it's saving you. Like, hey, maybe it saves me $30,000 or $40,000. Well, I take that and I buy another piece of real estate and I lever that up. I use it as a down payment and I buy more property. Sorry, Hugo, do you have a question?
Yeah, basically, I think I need to get you to review, because I got in the last couple of years maximum allowable deduction, even though I filed as a real estate professional.
Yeah, we'll take a look at it. Absolutely. But just so you guys know, I'll give you guys a link, but we'll do a free strategy session for anybody. I'm going to give you a couple free books too, and I'm going to give you tickets to our tax and asset protection event. All of that's going to be free. I'm not gonna play games with you guys. We're just gonna say, hey, if it works, it works. If we can save you money, we go forward. If we can't, then, you know, obviously keep making more money so that we can save you some money. Because I'll show you some things today that'll save you some money. Somebody else asked, if real estate is a 27.5-year asset, what falls under 5, 7, 15 year? So the real estate itself is not the 27.5-year asset. Land can't be depreciated. It's the structure that's built on the land. And so the structure, when you build a structure, like think of a warehouse and think of just the steel and the sides and everything else, that's 27.5-year, or in that case, it's a warehouse, it's 39-year. Everything else that goes in there, the HVAC, if you put in and you do a bunch of improvements, all of that is less than that. That is 15, 7, and 5. If you put in a bunch of cabinets and a bunch of countertops and you put in a plumbing system in so that they can have a little sink and a dishwasher, maybe all those things are unique to that property after. That's not part of the structure, and those things can be depreciated quicker. If I put carpeting throughout the warehouse, or if I treat the floor and then I put in a bunch of cabinets on the sides and everything else, all of that becomes 5, 7, and 15-year property. If I put a fence around the property, that's 15-year property. If I put in a driveway, that's 15-year property. If I put up cabinets, that's 7-year property. If I put in carpeting, that's 5-year property. We break it all down, and then you choose, the client chooses whether they accelerate it or whether they just leave it as is. I may accelerate the 15-year property only. I may accelerate the 5-year, the 7-year property only, because I may not want to take my taxes down to 0. I might be okay paying 10%, 15% total tax. I may say, hey, I want to have $100,000 a year showing so I can qualify for loans, right? So I may not want to go to 0. We see that all the time. People will sometimes play a little game with it, and they'll say, hey, what do I have at option? The question that we get a lot, just to see if some of you guys are thinking along these lines, you can do it on any property, even if they bought it previously. You don't have to do it the first year. You can actually, so if I have use me as an example. So we have several commercial properties in this last year at the, we're finding this out in the summer for the previous year that we had a lot more rents come in than we realized. And so we're thinking, all right, we're going to be pretty close to break even. We ended up positive 300,000, which, it doesn't sound like a huge amount, but we have a lot of properties and it's not that big of a swing. So we're looking at $300,000 of profit. I don't want that hitting me. That's going to go into the highest tax bracket. So I looked at it and I said, hey, let's take the property. We took one of our commercial properties we have in Tacoma, and we did a cost seg on that one property to offset the 300,000. Now we have 0 tax on all the rents. That's all you do. Somebody says, what if you were renting out a room in your home? Yeah, you could do that. So Lori, if you have a portion of your house that you're renting to a third party and it's more than 14 days and they're doing it continuously, then you can take that section of your house and depreciate that portion. I'll show you how to do that with your own company, by the way, because you guys are all, I bet you a lot of you guys are working from home right now. And the only way you can write that off is if you have your own business. And if you're a real estate agent, correct me if I'm wrong, Rudy, these guys are all independent contractors still in California, right? They haven't completely lost their minds.
Yeah, the state, they try to make it W-2, but no, it's still 1099 as of now.
I know, I'm just teasing you. Everybody here, I'll show you the way to write your house off. And it's going to crack you up as to how much money you can write yourself and not pay tax on. And it's not reported. You don't even report it on your taxes. We're not going to do this crazy home office deduction. I call it BS, which stands for something bad. I won't say, but right. I just look at it and say, this is stupid. Like, why would you do this? You're filing a special form. That's only if you're a sole proprietor. And I'll just say now, don't be a sole proprietor, period, at all. I'll show you all the numbers. And And if I show you the numbers and you still insist on being a sole proprietor, then there's no hope for you, right? It's literally 1,000% difference on your audit rate, and you're leaving money on the table. If I show that to you and you still insist, I'll be like Rudy's probably just going to shake his head at you and say, if you want to, hey, congratulations, you're a giver. All right, so let's go over this stuff. Why are taxes so important? I'm going to put it in real terms. So John, the saver, he's saving $10,000 a year because John's like, hey, he doesn't have a lot of expenses. He's a real estate agent. He's kicking some butt. And he knows if he puts it aside, he's going to make a 10% return. If John saves for 40 years, John's going to have a little bit of money put aside, right? If he's just doing it in his name and it's fully taxable, he's going to have, let's say that he has a before tax return of, let me change the color here, of 10%. And his marginal tax rate is 30, which he'd be lucky if he's making some serious money, but let's just say that, and he's making a 7% after tax return. He's going to have about 2.1 million when he retires. But we know that's not going to happen, right? John's going to make some life choices and he's going to increase his expenses, but let's just play along. Let's say instead we put that in a 401k, that John was smart and he said, hey, you know what? I'm a real estate agent. I can use a 401k. I can put the first $19,500 that I make straight into a 401k. And then my company can make additional contributions of 25% of anything that I'm paid. So I'm going to put $10,000 a year into a 401k. Now, all of a sudden, he's going to have, when he retires, about 4.8 million. Like, that's a pretty big difference between 2.1 and 4.8. But he's going to pay tax when it comes out. And so let's assume that he's still at the 30% tax. He's going to end up with about 3.5 million when he retires. That's fine. That's not bad. But what if it's tax-free? What if he's doing it in real estate where we literally can get tax-free returns? Then he's going to end up with the 4.8. And so I just want to see the difference. This is the difference between tax planning is 2.1, same dollars put aside every year versus 4.8. And you just decide which side do you want to be on. Would I rather have the 2.1 or would I rather have the 4.8? Me, it's pretty obvious. I think I'd rather be the 4.8. And in order to do that, you're either going to be doing either a Roth IRA, you're going to be doing things that are tax-free. So you may do muni bonds and stuff, but good luck making 10%, or you're going to do real estate. And me personally, I think everybody should be investing in real estate. It's the only asset where you literally, if I wanted to trade my real estate for other real estate, I don't have to pay tax. If I die, my basis steps up to the fair market value. My heirs don't have to pay any tax on it, and they can redepreciate it again. If I feel like giving it away, I can give it away and I can get full fair market value as a deduction. So if I want to give it to my own charity or if I want to give it to charity, I can do that. All of those things pop up and become huge. But we know that John's going to make life choices. And John, let's just say John gets married and he has the kids, he has the cat, he has the little babies all over the place, and he starts spending. Then they start looking around and they get told that they don't pay much tax. And that's what we hear in the press all the time. Oh, you know, the average American doesn't pay any tax. And that's a bunch of crap. The average American pays a ton in tax. In fact, the average American pays more in taxes, in federal taxes and state and local taxes, than they do in housing, clothing, and food combined. Combined, you pay more in tax. And the reason is because they say federal income tax, most people don't have to pay a lot. But what they don't say is that you pay Social Security on every dollar. And if you're a sole proprietor, you're literally paying it on every dollar. Like anything you make, you're paying an extra 15.3%. Old age, disability, and survivors insurance is 12.4%. Medicare is 2.9%. And they never talk about it. If I worked for McDonald's when I was 16, I made $4 an hour. I did not get $4 an hour. Even though I was in the 0% tax bracket, they withheld money from me. They gave it to the state. They gave it to the feds. It was Social Security taxes. It was unemployment taxes. It was all these things that came out of there that I did not see. So we have to be cognizant of the total amount. If I can cut that down a little bit, even if I can knock this part out on a big chunk of my income, which you all can do very easily, then all of a sudden your taxes get driven down. And so then, so now, see, look at John and Sally. They thought that they weren't paying any taxes. Now they don't look too happy. Now you look at it and you have something called Tax Freedom Day. This last year, it was in April. It was right around April 15th. And it's going up a little bit. I'll show you the numbers. Now they're not feeling so good. They had to pay all their money up until April. So they get a little pissy. But here's the real truth is that we're going into debt. In fact, did you guys know, and Rudy, this is one for you. Did you know that 23% of all dollars, all US dollars in circulation were printed in 2020? This thing called quantitative easing, where the Fed is putting cash into our market, that started in 2008 because of the recession, and they're putting in trillions of dollars. These are new dollars. So what's going down in value? Let's just talk about it. Mom saves all of her money. She puts it in a savings account. Her dollars just dropped. They made a whole bunch of new ones. What's the value of her dollar doing? And if anybody thinks that inflation is real, like that they're giving us the real number, it was like 1%. I got something to see, like, absolutely not. When you look at gas, milk, bread in the last 10 years, those have all gone up in the way double digits. And wages have gone up 9.9%. When I look at gas, it's gone up 60%. When I look at milk, it's gone up, I think it was 22%. I used to have all those numbers written down and easy. It's not even close. If you look at the inflation rate on things that we actually spend money on, not even close. We are not keeping up. You have to buy assets. You have to buy real estate. If you are just one of those people that wants to bury it in the mattress, at least buy gold or ETFs that are invested in in precious metals. If you're a gambler, buy Bitcoin. But those are your hedges. If you want to buy an asset that's going to go up in value and pay you money, you go into real estate. So now they're ticked off at the IRS. And so I say, Sally, because we have family audience, I took the bird out. So Sally, bad. No, don't do that, Sally, right? And so just to make everybody feel better, Canada has a tax freedom day of June 14th. So we can make fun of them. So sometimes our only consolation is that we don't live in Canada, right? So thank God there's Canada. They pay lots more taxes than us. And then we can make fun of Canada. We can all make fun of Canada. All right. So if we can just save $1,000 a year in taxes, $1,000 a year in taxes, we can have an extra $500,000 at retirement time if we do that for 40 years. This is why it's so important when you're talking to people that are looking to invest in things, is making sure they understand the tax ramifications of what they're doing. Because if they just do things the way the accountant's going to put it on their return, they're going to get less than half of the money. Look at the difference between these two things. If somebody knows what they're doing, they're going to double their return. So you need to know what you're doing so you can help people. Speaking of knowing what you're doing, it makes sense, and I'm not going to get political on this. I'm just going to tell you what's coming down the pike, because depending on what happens in that runoff in Georgia, you might be seeing this. And these are the proposals by the Biden administration that we're looking at, and it's going to affect you guys, period. And Rudy, I don't know. I don't know what your politics are or anything like that, but is it okay if I go over some of these? I usually get a hate.
Of course, go ahead.
All right, I did this with a big group, and I got a bunch of hate mail because they were like, "Why are you hating on Biden?" And I'm like, "I'm not hating on Biden. I'm telling you what the proposals are." Here's proposal number one. Well, I'll go through these. He wants to add payroll taxes to anybody who's making over $400,000 a year. Right now, the way it works is on old age, disability, and survivors, it goes up to $137,700. And that's 12.4%. He wants it to come back on anybody over there. He wants to add 12.4% tax on anybody over 400,000. He wants to increase the income tax. The top two brackets are 35 and 37%. The proposal is to make it 39.6%. keep in mind that your guys' state is what, 13%? So you're jumping up to about 52, almost 53%. I don't know how you guys feel about that. If you guys like it, write in the chat box how much you love the extra taxes. I'm just teasing. He wants to increase the capital gains, and get this. This is what's going to freak you guys out. The top capital gain rate that he's proposing, do you guys know what it is?
25%?
Anybody else want to guess?
Yeah, 25.
25? 39.6%. He wants to impose that on all capital gains and dividends over $1 million. Which, if you live in Kansas and you invest in real estate there, maybe you don't care. Maybe you don't have big properties like that. But if you're in Southern California, or if you're in the Bay Area, this is like, are you kidding me? Because remember, that's federal. Then you add the state to it, and you're looking at, like, California has a top 13%. So you're talking about getting hit with a 50-some% on the capital gains. Plus you have depreciation recapture of 25%. So if you don't know how to avoid those things, you're walking right into the end of a 2x4. You know, you're running into it. It's going to knock you out. Like, you could have a gain that you think you made $1 million and you're literally keeping 350, 400,000 of it. And then he wants to tax wealth. This is the problem that I have, is he's looking at getting rid of the estate tax, or the federal exclusion. He wants it to go back down to 5 million and then possibly down to 1 million. Right now it's a little over 11, what is it? 11.3, $11.4 million per spouse. And he wants that to go back down to 5 and then possibly back down to 1 million. So all it does is it puts people with large estates, especially if they have a lot of real estate holdings, in a weird position, because you don't want to get hit with that estate tax, because it starts at 40%. And then he wants to increase the corporate income tax. He wants it to go to 28%. And so when I say he, I'm just saying the administration. This is the points they put out. What would actually happen? They have to go through Congress. And so right now the House is definitely the Democrats, and the Senate is a toss-up. It'll depend on what happens in Georgia. So what it would look like on the expanded Social Security tax is, for people over $400,000, they're looking at that extra 12.4%. It could take a bite out of somebody. The top brackets, what they would look like is this. So your top brackets, you're looking at the 39.6%, just over the $400,000 mark. So when you heard during the run up to the presidential election, he said, "Hey, I'm just going to raise taxes on people above 400,000." This is what he was talking about. The problem that's not exactly how it works. If I am an S Corp, for example, this is what it looks like. The actual difference can be an increase in tax, and this is 20% plus growth, like increase. In some cases, it's getting close to, what is that? That's almost, yeah, that's going to be more than a 30%. That's a pretty large increase. So that's a 30% plus increase on the top wage earners, which means you got to have some tax strategies in your back pocket so you're not sitting there getting hit. And this is just federal, because now you're adding the state, and you guys, you're talking about a 50% tax rate. You got to keep your dollars away from that. And there's ways to do it, but you got to be cognizant of it, both for you and your clients. As far as the capital gains rates, this is what he's proposing. This is what it looks like. Anything above the $1 million is going to be in that 39.6. Right now, if you make $10 million, you got a 20% tax cut. And by the way, did you guys see that Bob Dylan sold his music catalog for $300 million? I don't know if anybody noticed that.
Yes, I heard it.
Yes, some of you guys heard about that. The reason he's selling it, I can almost tell you, is because they made an exception that's perhaps going to go away. And the exception was for artists. Ordinarily, That would be ordinary income taxed at his highest bracket. So ordinarily, his tax rate would be here. This would be Bob Dylan selling it. This would be Bob Dylan. He'd be in that top 37% plus whatever state taxes. And what they did is they said, right now it's treated as 20%. So he cut his taxes in half. And I can tell you that I'm sure that somebody's advising him saying, hey, Bob, the times they are a-changing, right? You better sell your stuff now before they jack it up, because you're going to pay twice as much in tax if you're not careful. And by the way, it's a joke that taxes have gone down. They have not. They've gone up every year over the last 5-6 years. The only taxes that have gone down is for business. Everybody else, they've gone up. So how do we fix it? Well,
they're gonna be because they make more money, or why?
taxes. So incomes have gone up, but in the last 10 years, they've gone up less than 10%. So there's a little bit of a misnomer. They do go up slightly. So what really looks the reason that individuals have gone up is because the business taxes went down. And so the businesses are paying more out to individuals. But businesses themselves got a pretty sizable tax cut. They went from a top bracket of 39% in the corporate rate. There's actually a 39%. Then it goes to 35. It actually does this weird, goes up and then it goes back down. So they always say 35. It was technically the highest corporate tax rate was 39%. That's now a flat 21%. And they gave companies that had moved money offshore, normally when you're repatriating it, it's 20% plus. And they said, hey, you can bring it in. I think it was around 10 to 15%. They gave everybody a reprieve to start bringing money back on shore. And then they're paying it out to people. So yes, there's a certain amount of that is, hey, some income went up. Incomes did go up over the last 4 years. Absolutely. But what they really did, and if you want to really get down to what they did that caused the tax increase here, is they got rid of miscellaneous itemized deductions. That went away under the Tax Cut and Jobs Act. That one thing took about half of the people that used to itemize and made them into using the standard deduction. So the SALT deduction, for example, state and local taxes, that they put a cap on that of $10,000. That hit anybody who made money in California, you guys got hit by that. They put a limitation on your mortgage interest deduction to $750,000. Anybody in California, like your average house in some of those areas is right around there. Like a lot of the houses that you sell, I don't know, Rudy, are you guys selling multi-million-dollar houses? Do you guys have people selling $800,000-900,000 houses?
Yes, all the time.
Yeah. So they limited how much of the mortgage interest you can actually deduct. And by the way, if somebody, here's a question for you guys. I'm going to do your tax knowledge. If somebody has a $1.2 million mortgage, can they write off all the interest if it's on their house, their personal residence? Can they
No.
write that off?
Not all.
And I'm just going to tell you, it depends on what it was used for. So the limitation is on the mortgage interest that is spent on the personal residence. If I use $500,000, let's say I pulled 1.2 million out of my house, 750,000 I can write off as personal interest as the mortgage deduction. The amount that exceeds that, if I used it on investment property, I'm going to write that off on page 2 of my Schedule E, and I'm going to write it off. And so I can write it off. I just can't write it off as a personal expense. I have to write it off as an investment expense. So if people have equity in their house and they're sitting on it because they're afraid to touch it because somebody's telling them they can't write it off, say, no, use your house, borrow against your house so you can buy more investment property. You can write it off then. I hope that's helpful to you guys. Just that one little piece. It's all those little things added up. So when you're talking to somebody who's sitting on, the $2 million house and they're like, oh, I can only write off a portion of it. use your house to lever into more. You don't have to get a loan on the property itself that you're buying. I can borrow money much cheaper against my personal residence and use that, and I can still write it off. I just write it off on page 2 of my Schedule E. Is any of that helpful, guys? I don't know if that's going to change anybody. I'm going to make some stuff very personal to you guys here in a second. But that type of stuff, I deal with this day in and day out.
So what you're saying is, if I take my equity in my home, I don't really have to take a loan against it. I'm just using it to get a better interest rate because I own my home.
You own your house, and they're using it as security on a loan.
Okay.
So whether I use the money from that loan to buy another piece of rental property, in the rental property, if I had purchased it and had a loan secured by the rental property, they may have charged me 6% or 5.9 or 5.8, right? A commercial loan. If I get it against my personal residence, they may charge me 3%.
Yeah, because it is higher, right? When you're going to buy income property. So got it. That's
And
great.
then the question people say is, but I can't write it off because it's personal mortgage. And that's not true. If you write off the interest on the personal mortgage on your Schedule A, you have a limitation. If you write off the interest as an investment interest on another piece of rental property, even though the loan is secured by your primary residence, it's still investment interest and it's still an investment expense. Then I can write it off, and I write it off on my Schedule E. So yes, you're absolutely, all of you guys should know that, like, especially in your area, that's a pretty big one. Now I'm going to turn it real quick to you guys and how to make extra money and how to overcome the myth. How many of you guys think that you're not allowed to get paid as a entity if you're a real estate agent? See how many people out there.
Of course
Put it
you're
in
allowed to
the,
get paid as an entity.
What's that?
I said, of course you're allowed to get paid as an entity. I've
Yeah.
been getting paid as an entity for 10 years.
Yep. But you'd be
Me too.
shocked. You'd be shocked at how many people think that they can't. And in a lot of states, they say that the agent can't receive the check. I mean, the agent company, but you absolutely still can. Even when people think, oh, my broker won't allow it. My broker will make won't pay it. You still can do it. And I'll just show you guys the difference. You guys should absolutely be paid as an entity. And that
So,
entity,
Toby, maybe you'll want to explain what you mean by entity to people, just so
Yes.
everybody's clear on it.
yeah, entity, yeah, we'll make it real clear. An entity is an LLC or an S Corp for you guys. I doubt we'll see any C Corps. These are the ways that you're able to get paid. And the LLC is taxed as an S Corp. So LLCs, limited liability company, exists in your state. It does not exist for tax purposes. There's no such thing as an LLC under the tax code. This big old document. There it is. There's Game of Thrones, by the way, which can't wait till they come out with the last book. Then it'll be like here, right? But this is 26 USC. This is the tax code. Nobody knows the tax code. It's too big. Tens of thousands of pages with over 1 million pages of interpretation. So just anybody who says they know the tax code inside and out is full of poo-poo. Don't listen to them. But there's no such thing as an LLC in that tax code. You just choose to be treated as an S Corp. And the reason you're going to do that is because it's going to save you on your cash on cash. Like it's going to increase your cash flow 20-30%. And I'll show you how. Number one, let's take away some of the fear. This is what's been going on with the audits in the world. Just so you know, this is from the 2019 data book that just came out. This data book here, this came out about 2 or 3 weeks ago. So this is 2019 data. And this is what the tax audits have been going. This little side right down here, these are field audits. This is where they come out and ask you questions. This one, this guy right here is where they send you a letter. It's called a correspondence audit. So the field audits have been steadily going down. All audits have been going down. And for you guys, depending on where you're sitting, like if you are $100,000 but under $1 million, this is what your audit rate's done since 2010. Look what it's done. If you make over $1 million, this is 1 million plus. If you make up to 100,000, it's not quite as good, but it's still pretty good. And I'll show you the actual numbers. They're attacking the poor right now because the poor don't defend themselves and they get lots of money out of it. So I always look at the actual data. If I'm not going to sit here and go through all the data with you, but I'm going to say the data, they give us all the examinations, who gets audited, who loses the audit. And I'll show you a couple pieces of information that might be kind of fun. But we can see who gets audited and who they go after. This is returns with the earned income tax credit. This is absolutely evil. And one of my clients is one of the guys that wrote the algorithm for the service. And what they found is that 80% of the people that are taking the earned income tax credit that receive notices don't respond. They're scared to death. These are the poor folks that are taking the earned income tax credit. And they audit them like crazy because nobody responds. They end up just paying the extra tax. You see the highest number on up here. All you got to do is look for the next highest number. That's people that make less than $25,000. And again, the reason the IRS is targeting them is because they don't fight the bill. They get collections, huge collections. Now let's take a look and say, what about the S Corp returns? What about partnership returns, businesses? This is the audit rate. For the partnerships, it's less than 0.005%.
Oh, there we go.
A fraction. S Corp's 0.01%. How many of you guys had an accountant tell you, oh, S Corps, they're more complicated. There are lots more formalities. Look them right in the forehead.
Can I make a quick
Yeah, go ahead.
statement here? Just to finding a balance on the opinion of why they are auditing more poor people.
Mm-hmm.
A lot of poor people get state benefits like food stamps, et cetera, correct?
Correct.
I'm personally witness of these people making a lot of money out of that and doing crooked business on it. And perhaps that's why they don't go back to the IRS, because they know they're going to be cut. That's just my comment.
Yeah, there's a number of reasons as to why. I don't think that, like, I think that those are outliers. I don't think, like, it is systemic. It's a large number, but it's a small percentage of a huge group, you know. And so I understand state benefits and food stamps, but if I'm just looking at federal taxes, why are they auditing folks that make less than 25,000? Because technically, especially if you're married, you pay zero tax on that.
Well, it's like you said, Toby, it's an easy mark and the fines are a few $100. So you get 100,000 people paying a few $100, man, you're making millions of dollars on somebody who basically paid what they amounted to a parking ticket,
Yep.
right? Or a speeding ticket, right?
Yep.
And they're getting millions and millions of dollars doing it because they don't want to fight back.
Amen. That's it. The guy that wrote the algorithm said exactly that. He said all they did is they found that they don't defend themselves, whereas the rich people always get a lawyer and accountant. Yes.
Would you please tell us what is the threshold when you should switch from LLC to the S Corp as far as income? When is
So I'll look at it from two sides. from asset protection side in this world, not knowing what COVID is going to bring us as far as the liability, until there's protection for y'all, I'd say it doesn't matter whether you're making $5 or 5 million. Make sure you're operating through an entity so you don't find yourself at the wrong side of somebody trying to extort money from you. The lawyers are going to find a way to make money at this thing. And there's a reason that that liability provision is what's holding up the stimulus, because the attorneys bar, the National Bar, does not want liability protections built in for businesses that reopened, or for anybody for that matter, because the lawyers are going to have a field day. All you have to show is that somebody got COVID while you were doing showings or something else. And the next thing you know, you're going to be dealing with a pandemic suit that's not going to be covered under most insurance policies. So I would have an LLC from day one. From a tax standpoint, it makes sense. I'll show you the numbers. It will save you about $1,500 per year at $25,000 a year. So if you're making profit of $25,000 a year as an agent, you should be an S Corp. It's going to save you that much money. And that there is the extra tax return, which I'll show you the tax return side by side. But here, let me make this really clear. If you're making
there's the holding cost of owning the corporation, which is like $800 a year.
$800 a year, whether you're an LLC or an S Corp, even if you're a sole proprietor operating as an LLC. So if you want the liability protection, California is going to hit you. And then you have the cost of the return. And that's why I say about $1,500 is what you save at $25,000, and that's going to cover your costs. Rudy, what does your average agent make, if you don't mind me asking?
Yeah, it range from 70,000 net income to be, that's the outside sales, all the way up to over $1 million GCI, because we have two different types. So one is the outside sales to be with no expense.
Just say your average agent makes about 150, Rudy. He wants a nice average number. A nice average number is probably 150 across the board.
And Toby, you need to know later on, you're dealing with two groups of people. One agents here, the outside sales, when they come to you, Toby, literally they have no expenses. It's a net income. And then the other ones is the team leaders you're gonna see with expenses, especially the one with no expenses, Toby, the 70, the 80,000, that's a net income. They're gonna get hit a lot by taxes.
Yeah, I could show you guys how to knock that down. But here, let me just look at the data. So this is the average year. This is the brand new data. I could just say that if you're in this range, so let's say 150 would fall right here. You're at a 1.6% audit rate versus, you remember the S Corp was 0.01. So just to put two comparisons. Now, when you get audited as a sole proprietor, this is the percentage of returns with no change, where they don't assess additional taxes. 5 and 6%. In English, what does that mean? That means if you're a sole proprietor, you lose your audit 95 to 94% of the time. So I just look at apples to apples. I'm like, do I want to get audited or do I not want to be audited? You guys decide. And it might not seem like a big number, but that just means you'll get audited in your lifetime at least once and lose. And when they audit you, it's not 1 year. They extend it over 3 years, especially when they find money. They're just going to say, oh, and if they find something really wrong, you get to enjoy the audit almost on an annual basis. So I'll just put it in English. If I had two options, sole proprietor versus S Corp, to me, it's not even a question, right? Option one, I'm gonna have about 1,000% more chance of getting audited. It's actually about 1,600 under that situation. And I'm gonna lose 94% of the time versus, hey, I might get audited once every 500 to 1,000 years as an S Corp. And if I do get audited, my win rate's actually quite a bit higher. I'm going to lose about 62 to 71% because we know why they audit S Corps. And the easiest reason people audit S Corps, there's only one, is if they see distributions with no salary. If you take money out of an S Corp, you have to pay yourself a salary, usually about a third of the amount. If you don't, they're going to ask you, why didn't you pay self-employment tax on that money? Because that's the difference between a sole proprietor. Sole proprietors pay self-employment tax on all their dollars. S Corps pay self-employment tax on about a third of their dollars. Easiest way to think of it. But the S Corp has something else in its corner, and that's called an accountable plan. This cannot be done with a sole proprietorship. I see accountants try to do it, can't do it, right? If you are a proprietor, you cannot be an employee of the company. So sometimes they'll put a spouse on it or something. They'll do some goofy stuff, and they're going to lose. That's why the IRS's win rate is 90% plus, right? But this is what it says, is that if you reimburse yourself as an employee, and by the way, if I have non-reimbursed expenses right now, so like everybody that's working at home, and let's say they work for an employer, if that employer is not reimbursing them, you can't write off your home office expenses anymore. It used to be you could, but the Tax Cut and Jobs Act did away with miscellaneous itemized deductions. You cannot write that off as an individual anymore. You have to have an employer. And when you have an S Corp, you now have an employer. It's the S Corp. And what the regs say, and this is CFR, so the Code of Federal Regulations, is it says amounts treated as paid under an accountable plan are excluded from the employee's gross income, are not reported as wages or other compensation. It's not reported. This is no different than if you brought donuts into a meeting with Rudy and Rudy gave you $20 for the donuts. Hey, thanks for bringing the donuts. Here, I'm reimbursing you. You don't have to report the $20. Rudy can still write off. Okay, give me the receipt for the donuts. Now Rudy's going to write that off. That's all this is. What you don't realize, it's exempt if you're doing it with your own S Corp. And the expenses that I'm going to write off is going to be pretty extensive. I'm going to do everything from education expenses, travel expenses, cell phone. I'm going to reimburse an administrative office in my house. That's going to allow me to write off about 20% of all of the expenses. Even if I have a maid come in and clean, or house cleaner come in and clean the house, I can write off about 20% of it. My property taxes. So let's say I have a house that has $15,000 a year property taxes, and I can't write it off because I have the state and local tax limitation at 10,000. I can reimburse myself for a big chunk of that. I'll show you how to do that. Before we go there, I'm just going to do side by side with everything, including the 199A deduction, which is the 20% pass through, with taking payroll, with old age disability and survivors, everything. If I do a side by side comparison on two businesses, one that's a sole proprietor, one that's an S Corp, and it'll show you without even using the accountable plan, how much you will save just by doing it through the entity. In this particular case, you're talking about, what is that, about 6,000 plus, without getting into the rest of the differences, without getting into audit rates or anything else, without getting into all the added tax benefits. If I just went side by side and said, you did nothing else but pay yourself a small salary, and the rest of it comes out and avoids the self-employment tax. If I do that at 50,000, I'm still saving $4,000 per year. And remember what $1,000 a year adds up to when you're doing it, when we're looking at retirement planning. Remember that $1,000 a year ends up being about $480,000 upon retirement. So if we can save ourselves $2,000 or $3,000 a year, that's a pretty big difference in the ability to retire if you invest it right. And then I forget who asked the question. I think it was Judith. But if you're at 25,000 a year, you're still saving right around, it looks like it's right around the $1,500 mark.
So can you take that money that because you've given yourself a salary.
Correct.
And so say I make 100,000 and I've only paid myself 40.
Yep.
So I have, I have some money in there. Do I buy my investment property the down payment and all that, can I buy it through the S Corp? Is that what you're saying, what I would be doing with the extra
No.
money? Or how does that work?
No, so an S corporation is no different than you from a tax standpoint. It passes its taxes to you. So if I have $40,000 and I have $60,000 in the S Corp, that equals you. You can take that money out. You just don't have to, you don't pay any tax because it's a flow through. That $60,000 profit's going to be on your K1, whether you take the money out or not. So if you make 100 and you take salary, I'll show you the way to do it actually. That this is going to trip you guys out a little bit at how much you can actually save. If you're making $100,000, the way that I would do it is I would defer into a 401k. I'd put 19,500. If you're under 50, you can put 19. If you're over 50, you can go 26,000 right into a 401k. So let's say you paid yourself 40,000. You just removed 19,500 from that equation. So now you have, what is that, 20,500 left? The company can then take whatever you paid yourself in salary. So that if it's 40,000, the company can take 25% of that amount and put that into the 401k as well. So it can take another $10,000. So now we're lowering ourselves another 10,000. So when we take a look at those things, we've just put in $29,500 tax-free, and that's going to lower your 100,000 bucks down to, what would that be, about 70,500. That's your new taxable income. That's when this stuff's really powerful. And can you buy real estate inside of a 401k? Yes.
Does it have to be a self-directed, or you can still do it with a regular 401?
401ks are 401ks. When
Okay.
somebody, when somebody like a Schwab or somebody does them, they don't care. You're going to have somebody else's plan doc. When you go to a IRA custodian, they're going to put in that you have to have a custodian. So when I set them up, you're in charge. You're the trustee. So you're in control of it 100%. And there's a huge difference between IRAs and 401ks. So for example, if you lever the asset inside of a 401k, you can do that without having to worry about unrelated debt finance income. If you're savvy on these things, some of you guys know what that means. Some of you guys are probably going to look at me cross-eyed. But you can lever inside of a 401k without tax. You cannot do that in an IRA. In a 401k, I could immediately loan myself, by the way, if this had been a few months ago, the 100% of it, but I could just give myself, this case would be 14,000, what would that be, 750? Whatever that is, it's 14, I can't add. I'm just gonna call it 15,000. You could pretty much borrow half of it. And if I wanted to use that, then on my real estate, I could use that to lever up.
Yeah,
So,
what I see a lot of is when we're working with self-employed, a lot of times they hurt themselves so much because they don't have this kind of information, and they don't want to pay taxes. So it shows now that a person who's making 200,000, but they only pay taxes on 40, so they can't buy the property.
yeah, well, you have to look at it, and there's three sides to it. We always say it's like there's lawsuits, making sure that you're protected, there's tax, and then there's the business planning side. You don't want to take yourself to zero because you become unlendable. So you always want to make yourself lendable. So when we're talking about you doing the cost segregation, that's what I said. Sometimes you don't take it all because you don't want to push yourself into the zero. It always comes down to, what are you trying to show? Now, here's the other thing. And it sounds like you're savvy on lending. On page 1, the underwriting criteria is they're using 70% of the rents on page 1 of your Schedule E. If you do this and you're doing this, either your rents through a partnership or you're getting the K1, they're using 100% of the number off of page 2. Little things like that, when you're dealing with your client, you become a little gold. So when you're talking to somebody and they're saying, hey, I want to qualify for a loan or I want to buy this, before you even lend, you're looking at their return and you could say, let me see your Schedule E. All right. So you have a bunch of real estate and they may be showing it on page 1. So they have 3 pages of page 1 of their Schedule E. If you don't know what I'm talking about, it's their list of real estate where it's showing their investment income. If you just move that to page 2, they're going to have 30% more income showing for loans.
That's awesome.
Yeah, goofy stuff like that.
And what protections does the S Corp have as far as like my home? You know, and somebody coming up with a lawsuit coming towards me or anything like that.
Well, it protects your real estate activities. It separates it. So if you get into a car accident, is that going to protect your house? No.
No.
The S Corp will have nothing. But if you have real estate and you isolate it into an LLC, then they won't be able to take the real estate. And we usually move the holding company out of the state that you're in. So California is pretty tough. And by the way, there's a way to avoid the franchise tax on real estate holding entities right now in California. Last year, a tax ruling came out from your Board of Equalization. It's called a disregarded limited partnership. It's kind of bizarre, but it avoids the $800. So you can still put asset protection in place for, we'll see how long that lasts. They didn't change it in this legislative session, but they're going to have, they'll probably change it at some point to try to get away from the $800 a year of the franchise fee if you have multiple LLCs. So there are some tricks to making sure that you don't have to pay the franchise tax on a bunch of different entities. We usually try to give them one that will pay it on. But the big difference is whether or not you're showing that on your page on page 1 or page 2. For somebody who's growing their portfolio, we want to make sure that it flows through onto page 2, and we want to make sure that nobody can take away your investment assets, period. And there is a way to do that to where they can't take it, and that's by using an out-of-state LLC, usually Wyoming or Nevada. And go ahead.
No, I was going to say you can also protect your personal residence by having a HELOC ready to draw. So if somebody sues you, you pull your money, they have no equity.
Technically, when you touch the money on the equity, that's a fraudulent conveyance if you did it in response to the suit. So, but I agree with you, the HELOC will prevent the suit almost always. And if you have friendly liens, that will prevent the suit too. So like even if you don't want to go get money from a bank, you could have another one of your entities draw up a line of credit and file a deed of trust against it. So it looks like there's no equity in the house. The vast majority of lawyers, and I'm just going to, like, I'm not a traditional lawyer. I don't sit there and go to court, and I don't like the guys that do the contingency fees. I think that's horrific. But a lot of those guys are lazy. They're just looking for low-lying fruit. And so we've seen in California, I could give you 2 cases that were 30 million plus. In one case, it was a father and a son. The son was our client, the father was not, and they jointly owned a nightclub in Los Angeles. And there was a kind of the scenario is this: there was a valet, and the valet ran the car into a patron and pinned him against the wall. They thought they were in reverse and they went forward. And there was double amputee. So I won't give you all the facts because you could probably figure out who it is. But the dad was not structured, son was. Son, we settled for almost the deductible like that. The dad is still embroiled in that lawsuit. And the funny part was the dad has much more, or the son has more assets than the dad. But because it looked difficult with the son, they couldn't see what he had. They just went right for the insurance, and that was it. Done. Out. Didn't even have they have the relationship where the son makes fun of the dad, and we get on we're always talking to those guys, and the son still makes fun of his dad all the time. Like, they're pretty affluent. They're not horribly worried, but there was an exception to the policy when you had third-party vendors in the nightclub. So a lot of people say, "Well, sue the valet." We get to sue the valet, but the primary responsible party is the landowner in the club. All right, I'm going to show you guys another way to put money in your pocket. And this way, the beautiful part about what I'm going to show you now is anybody who has an S Corp. And by the way, this is the difference. This is an S Corp return. This is a Schedule C on your 1040. This is sole proprietor. You can see the name right there. And you're just going to have to tell me which one looks more difficult. It's not what everybody thinks, right? Everybody's always telling you, oh, those S corporations are so difficult.
Hey, Jennifer, can you mute yourself, please? Thank you. Toby, real quick, for all intents and purposes, if you've got an LLC, would it treat that sort of as a somewhat analogous as your S corporation examples here in California?
If it's
You've got a single member LLC?
No, because a single member LLC is a sole proprietorship unless you make the S election. But you can make the S election with a single piece of paper. You file the 2553, that's all you need to do.
And then just change, just that ostensibly changes the election how it is.
Correct.
Okay.
Yep. Let me show you guys this. This is going to trip you guys out because this doesn't go on your tax return at all. It just shows as a rental expense or lease expense to the corporation, and you don't have to report it on your personal return. And the way this is done, and this is actually via the IRS, so you guys can go look this stuff up. It's called an administrative office for the home. And the reason that this isn't popular, like most accountants don't know, is because they didn't change the court cases. They changed the law, which made the court cases moot. So it used to be to have a home office, it had to be your primary principal residence, like your primary principal office of the business. You don't have to do that anymore. An administrative office works. So you could have a business that has a regular location. So for example, you might have a spot in a realty brokerage place, or you may have commercial property, but you go home and you do your billings and things like that. That would be a prime example of having an administrative office in your home. Or with COVID, they say, hey, don't work in your office, work from your house. Now you have an administrative office in your house. You're not renting it to your S Corp. You're not renting it to your LLC. You are simply reimbursing yourself because you are giving them access, your business access to an exclusive area in your house. And they call it exclusive and regular use for your administrative services. And then what you do is you grab two types of expenses. There's direct and indirect. Direct means, hey, I had to wire internet into that room and it cost me $100. Indirect means I paid mortgage interest, I had real estate taxes, I had homeowners insurance, I paid utilities, including electric, gas, and water through the year. I had internet expense, and I had it cleaned once a month for $100. This is actually a pretty much a close case analogy. In this particular case, they had purchased the house for $460,000. 100 of it was the land value, which means we actually had some improvement basis, $360,000. The IRS tells us what percentage to use based off of what month and what year we put it into, it started using it as an administrative office. Under this situation, there's $8,859 of depreciation that we could take if it was an investment property, but it's my home, right? But my employer should still be reimbursing me for their portion of that expense. I hope that makes sense. In other words, they're getting the benefit of my house. They need to reimburse me for the fact that that house is going to have to be replaced every 27.5 years. They don't let you accelerate the depreciation on this one, by the way. They just use it. This is literally from the Internal Revenue Service. They give us the provision. Once we know these expenses, so I know that I had to wire the room, and then here's my indirect expenses, my depreciation. I have a total amount. Now I get to figure out what percentage I need to reimburse myself. In this case, on this particular client, they had 665. They had actually a larger room that they used for their home office because they did some video and stuff like that. It was a larger space. But what we had is exclusive square footage for that particular office. So you can go measure it out and things like that. Then you look at the usable. This is different than you do on the home office, like a sole proprietor. Sole proprietor has to use the square footage that's available in the house, period. We use usable net square footage, which means you exclude the hallways and bathrooms and closets and stuff like that. Or we say, are there basically equal number of rooms, like spaces? So like the living room, maybe there's a kitchen area where it has a living room in it. That's one room. Then we have bedroom, that's 2 room, another bedroom, 3. Now we have a big den. All right, now we have 4 rooms. And we can choose which one is in our best interest. The IRS says we can use any reasonable methodology, and these are both accepted. This one's going to give us 0.277, which is going to give us the ability to write ourselves a check of $12,918. So remember our $100,000 example that we were using, and we pay ourselves $40,000 of salary, and we put 29,000 into, I guess we would just do this. We'd say this is the tax deferred. This gives you another $12,918 deduction. It's going to continue to lower our taxable income. So at the end of the day, when we're said, we're going to have to our bottom line somewhere, what is this? 30, 31, 41. So we're right around $60,000 of total taxable income. Then you get to take your, let's say you take your standard deduction. So you take 24,800. That's going to get you down pretty good from a tax standpoint. That's going to get you down to what, about $35,000 of taxable income, which is a heck of a lot better than 100. Just saying. That's how that works. Now, if you want to do it even and push even harder, and you want to lower your taxes even further, there's a ton of other ways. You can do all your cell phone and all those things. You can even do when you drive between your offices. Normally that wouldn't be a deduction because it would be a commuting expense. But if you do that and you have an administrative office in your home and you drive to your other office, now it's all reimbursable mileage. So you're getting usually somewhere around 59 cents per mile, 57, 58. It moves around about every 6 months. Now, here's another way. If you use your house once a month and you are a corporation and you have a board meeting, I would suggest that you have it once a month, 1 time a month, and actually have a meeting in your home. Bring other agents in. I know you're probably not allowed to do that in California right now, right? But let's just say that you have other people there, or you do like we're doing today, and you're going to have your meeting in your house, but you're going to do it in your main area of your home, maybe in your kitchen, maybe you're doing it in your living room. We want to use the entire house. You can reimburse your house. You can reimburse yourself from the corporation for the use of your house. It's called 288. It's what Airbnb people use all the time. When they rent their house out, when they go on vacation, they say you can rent it 14 days or less. This is the rule that they're using. It's been around for more than 30 years, and we've been using it for 23 of those. What it is it's a provision that disallowed a bunch of the home office expenses. And so whenever you look at a provision that's disallowing stuff, you look for the exceptions. And so they have an exception. And the exception is when you're renting the house, let me see if I can move this thing. So it says special rule for rental use, notwithstanding any other provision of this section or section 183, if a dwelling unit is used during the taxable year by the taxpayer as a residence, and such dwelling unit is actually rented for less than 15 days. 14 days or less. I don't know why they say less than 15. Then the income derived from such use shall not be included in the gross income of such taxpayer under section 61. That's your adjusted gross income. What that means is your company can reimburse you for the use of your house if it's using your entire house, and you don't have to report it and you don't have to pay tax on it. The company deducts it. The kind of like in English, it means you can rent out your house to your company. And who should we rent to? We're going to rent to our S Corporation, period. And everybody that's been using this, I see if somebody says they love this rule. This absolutely works. It's been tested. There's one court case, but we've gone through 2 audits over the last 23 years where this became something that they looked at. And in both cases, they agreed with the methodology because we back it up. We always call, or we tell our client to call 3 locations near them and get a quote, usually at a hotel, say, how much is a meeting room? And you are allowed to reimburse yourself, whatever that amount is, whatever's a reasonable amount. So in one case, it was North Dakota, and $500 a meeting was a reasonable amount. And that was about 20 years ago, by the way. It wasn't our client at the beginning, but because of we do a lot of YouTube. So they saw us on the YouTube and they said, hey, my accountant doesn't understand this. Would you guys defend me? We picked it up. We defended. It was actually a tax court case, and the IRS found it reasonable the way that they did the methodology. In the other case, it was a client who they individually got audited. They looked at the company or the corporation as part of that audit, and they questioned this. It was $1,100 a month. And in that particular case, we had 3 quotes, and they accepted the 3 quotes. The IRS isn't ogres. They just make sure you follow the rules. So basically, all you're doing is you're saying, hey, I'm a shareholder, but we want to have our directors meetings once a month in our residence. We want to use the entire residence. Maybe you bring other agents in. Maybe that's where you're just having a general meeting. Whatever the case, you're going to discuss business. You're going to have your board meeting. And whatever it would have cost you to do that at a third-party location is what you're going to pay yourself. So a pretty easy amount here in Vegas is about $750. We have multiple quotes for more than that. You don't have to be a pig on it if you don't want to, but you could push this, or you can be real plain Jane vanilla. I just say, just look at what it costs. You're going to ask them how much for refreshments, how much for the internet, how much for those things. And you're going to see that it goes up pretty quick, but it allows you to get another $10,000 a year out tax-free. Remember, you're going to end up being able to push your taxes down. And then the question becomes, should I push my taxes down? Because if I do I make myself unlendable? And so that's a discussion we have to have, but at least you know that you have these things at your disposal. Now, there's probably 20 different versions of that. I could show just about anybody how to lower their taxes, even if somebody is making $2 or $3 million a year. I'll give you guys a quick synopsis. I had a client come in, 3.2 million. His accountant told him he was going to pay 1.2 million in taxes. Contacted me in November of it was 2 years ago, November. We just did his tax planning for this year as well. And I looked at his scenario, and we were able to get him down easily underneath $1 million of taxable income. And the reason being is because you have so many things at your disposal. In his particular case, he had a lot of real estate that he'd already let depreciate. We contributed that to his charity. All of his real estate was in Indianapolis, and it all qualified as low to moderate income housing. It was all HUD or below. And that's actually charitable activity. So we set up a 501c3. He got a $1 million plus deduction that year, which saved him in that particular case. In his particular case was about 40 cents on the dollar. So he saved about $400,000 just on that. It's in a charity though, and it's going to continue to grow, and it's going to continue to generate income. And that's a charitable activity, but it kept it off of his personal taxes because he's making too much money. We also did a conservation easement, and we did a defined benefit plan. So he was able to put hundreds of thousands of dollars in his defined benefit plan. Think of a defined benefit plan as a 401k on steroids. Instead of $50,000, $57,000 a year, you're going to be putting in closer to $500,000, depending on what your income is, because we reverse engineer. We calculate how much you get out of the plan and then determine how much needs to be in the plan on retirement. There's all these things at our disposal, but his accountant, I told him there wasn't anything he could do. There's always something you could do. Just to give you some ideas for anybody that's with Rudy, we're going to give you guys tax-wise, it's my 4th edition of this particular book. And just so you get an idea, I'm on Forbes Council. I've written books for the Nevada, or for Washington, actually, Washington Contract Tax Practice Guide for Nexus Lexis. I write extensively. I do USA Today. American Express just interviewed me, and I have Bloomberg Tax. So this isn't fly-by-night crazy stuff. This is tried and true bread and butter. If you're a business, you use it. We'll give you this book. We'll give you Clint's asset protection for real estate investors, so you can bone up on that, because that's another aspect for some of your guys. And we'll give you 2 tickets to our 3-day event, tax and asset protection. When we start doing them live again, it's a great place to come. Rudy sometimes brings a whole group in and we just do Rudy. Sometimes I come to you guys in California. It's fun to hang out with Rudy and Vinny. You guys we get to have some fun. We'll give you all that for free and give you a strategy session. No cost, courtesy. We love Rudy. We love working with you guys. That's the link right there if you want to sign up. Real easy. And if you don't want to do anything, you don't have to do anything. Just to give you an idea of what it's like to work with us, and Rudy can talk about it, or anybody that's a client can talk about it. We have a service called Platinum. It's $35 a month, and you can ask us any question. You can talk to our attorneys at any time. There's no bill for it. If you have tax questions, you can submit them in writing, and there's no cost. We'll have a CPA, EA, or tax attorney respond to it, and there's no cost to that. Like, that's part of the service. If you have contracts that you want reviewed, we'll do 2 a month. So if you want to submit that, there's no cost to doing the review. They'll look at them, and our attorneys, again, we look at the best appropriate person, and we want to make sure that you're going in the right direction. That whopping $35 a month, you can just keep going. There's a ton of documents and a bunch of videos in there too. I'm not doing it justice, but the idea is that we don't want to hit you with hourly fees and things like that. Just ask basic questions. We want to keep you out of trouble and make sure that you realize that, like, we're a pretty good resource. We'll help you grow your practice. We'll help you grow your business too, in a very different way, by helping you keep more. But also, sometimes it's just problem solving. You get a client that has a scenario. I get these all the time, and they'll say, like, we had a scenario. Rudy was shooting me up on an email the other day saying, here was an issue. I won't give you the issue, but he's like, here's the issue. What do we do? And I said, well, you could try this. We could try this. Oh, okay. The way that we tried it, it worked, right? Simple. No bill, no nothing. You're able to just come up and shoot it at us. And if you're part of our Platinum group, there's no cost on it. Frankly, I don't answer those questions for people that aren't, because I don't want to track my time and I don't want to create a bill. Rudy, this is what you asked me, right? You wanted me right around 9:45.
No, that's good. And the point is this, you guys. So here we teach you every day, from January every day till December cleans. Every day we meet from 8 to 9, teaching the agents here how to make boatloads of money, right? To follow our system. And then the agents that follow our system, Toby, every year they always get hit by tax, because the way we teach, there is no expenses. It's a net income for our agents. Oh, by the way, you guys, what Toby is sharing about just now, the 14 days rule, any of you can do it now. For example, the simple way is when you do your mock buyer's appointments, your mock listing appointments, right? It doesn't have to be a lot of people. So you have 3-4 people come to your home, and that's the conference.
Well, that's perfect, Rudy. Yeah, if you're gonna have other people there, you could even buy refreshments and stuff, and it's 100% deductible.
Yeah, and you know how much, Toby? Remember last time when you came to Monrovia, that hotel room, it cost like $7,000. So what Toby is saying is that you call the 3 hotels in your area how much to rent a conference room, and that will be your comparable.
Yep, just make sure it's compatible, like square footage wise. I've had a client actually do, he used to do the glass walking, and he would get this big room, and it was almost 30 grand. And what we did is we got a tent in his backyard, and he paid himself 30 grand. Because that's what he was paying for the hotel. He would do it in High Point. They did it right around when all the furniture things are going on, and he'd teach people to, walk across glass and do all this trust exercises. He'd always take them into his, he had a big backyard, and he had an obstacle course and stuff back there, but he had the glass walking in the hotel. And I said, well, just keep that receipt, because you could pay yourself. It cost him about $1,000 for the tent. And now he's able to reimburse himself for similar accommodations. 100% legal. That's the way you do it. The IRS just wants you to make sure that it's a reasonable amount. And that's all they care about.
And remember, Toby is your, so Toby, last point that I want to make sure everybody clear is that for me personally, I never get advice from some random Joe Blow, right? As you know, as an agent here at your home sold guaranteed realty, Toby, we give them access to real estate attorney, litigation attorney, contract attorney. So we have like almost a dozen attorney who specialize in different areas of law, an attorney who specializes only in DRE. What you are meeting today, Attorney Toby Matte is my personal and our company, your home sold guaranteed realty, asset protection and tax strategist. Like this is the guy that I personally use since 2009. If you look me up, do a search, title search on, do an asset search on me. Look up what I own. You'll find nothing. And because Toby, so if you want to try to file a lawsuit against me, right? You're like, there is nothing. And that's basically the genius behind all that. Is this is the man, the brilliant who set up all that, and all of you have access to it. And if you have any questions, you guys, just like every day when you have a real estate question, you ask the RERM, right? You have the same thing with this. Any tax questions and asset don't go to Google or don't call Uncle Bob who works in McDonald's full time. You just ask Toby. Like every time I ask Toby, you just shoot an email. Like Toby said, there is no additional cost. Can you imagine having the top tax attorney in the nation at your retainer for only $35 a month?
I don't answer them all, Rudy. For you, I answer them, right? No, it gets escalated. Rudy just goes straight to him. He bypasses the portal because he's Rudy. I just
want to say that this morning at 7 o'clock, I had my call and I have already started my S Corp and putting all my assets into the Wyoming everything. Perfect. Because my wife just had a car accident and I don't want anybody to take away all my assets in one swallow.
Can you put up your slide back up so people can see? When I just want to make sure everybody understand when Toby mentioned the strategy session, you know what a strategy session is? You literally gonna do sit one-on-one in person, and then Toby and his team is gonna review your case at no cost. So Toby, can you, because most people don't understand what a strategy session is. It literally is a tax planning and asset protection session for free because you are with, it's not free, Toby. We should use the word, it's included because you are part of your home sold guaranteed deal. Nothing is free, by the way.
I'll tell you, what we're going to do is create a blueprint for you. So we're going to look at it, and what it usually looks like is kind of like this. We're going to create, in many cases, we're going to have an estate plan. If you don't have an estate plan and you live in California, you're crazy because you have statutory probate fees. They're ridiculous and they take too long. It's so much cheaper just to make sure you have something documented. But you're going to have an estate plan, and maybe you'll have your business sitting out here, and your business might be an S Corp. It might be an LLC taxed as an S Corp. And then maybe you have real estate properties. And so we have different states, maybe 1, 2, 3. And we just kind of diagram it out, what it's going to look like. Maybe we have a Wyoming holding company. And for all you guys that are worried about Proposition 19 or Prop 13, you don't have to worry. The way we structure these is that you're still the ultimate beneficiary. You're exempt from the step up, the reassessment of the tax, but we can still get your name off the property. We can even get your name off your property, your personal home. And the way you do that is by using something called a land trust. You know, it's just a basic grantor trust, and they do exist in California. There's no statute on it, it's common law, but you create a trust just like a living trust, but we don't put you as the trustee. The reason you do this on rental real estate is so, like, let's say we have all these properties, and like what Hugo just said, somebody is out here, maybe it's a kid, maybe it's a spouse, maybe it's you. If you get into a liability issue and there's third parties looking at it and they want to see stuff, they can't see anything unless you show it to them. We may show them just the business. That's it. But we're not going to show them your house. We don't want to show them all your other assets. We want to make sure those are in different names. And the reason being is because you don't want them to get Mr. Lawyer who says, oh, this guy's got something to lose. Let's go ahead and file something really angry. And, you know, I call it a rule is there's actually a term for it, which is called master of pleadings. If I know you have insurance and I know that all I want is the insurance, I'm going to plead things that are within that insurance policy. If I see that you have a bunch of other assets, I'm going to plead things that are not covered by that insurance policy. And the first thing that lawyer's going to ask for, what do you think it is when they say they're going to sue? They ask to see your insurance policy. What you want to make sure of is that, like in Hugo's case, wife gets into a car accident, is that they get that policy and they stick inside that policy. Once they know what its policy limits are, that's what they start asking for. And it keeps you out of harm's way, so they're not going and expanding it further. Sometimes you can't help it. Sometimes if you have a death, sometimes if you have something that's really heinous, or you have a land deal that goes south, or we have a great recession like we did in 2008. So we had clients that were on the hook for again, 30 million plus was a case. You could actually go read about it. Eddie Russell, he was on our site. We were able to get him out of that for less than 2 million, and he was on the hook for 30 million plus.
Hey, Toby, sorry to interrupt you here. Somebody mentioned it in chat and I just noticed it too. There's actually no strategy session dates available going through February on your Calendly site.
Toby,
we will be
for
reaching
your
out.
home sold guaranteed realty, Toby, can you give up your Christmas vacation?
We will get you guys. We will get you guys. Don't worry. They probably just didn't go and open them up because at the end of the year we get crammed. So if you just sign up, we'll go through and we'll reach out to you and we'll make sure that we get you with somebody here pretty quick. So we'll make sure, and I'll ask our guys, make sure that we have something opened. They're putting people aside because the end of the year, these last 2 weeks, you could literally lower your taxes with the stroke of a pen, the way we put structures together. And for those of you guys who are over 7 figures, there's a very strong likelihood that we're going to take you into the nonprofit realm, into the 501c3, which, you guys want to know something crazy? And Rudy, you may know this because I think I may have mentioned it. Do you guys know that IKEA started out and continues to this day to be a nonprofit? IKEA, where you go get frustrated by buying their furniture and not knowing how to put it together. To this day, Ingvar, the way he set it up was 2 of the holding groups are nonprofits in different countries, and then his family gets a third. But that way they can't break up the company, they can't sell it, they can't do anything. There's so many activities that actually qualify.
Yep.
And real estate's one of them.
Yep, Toby, sorry to cut you off here, but everybody, as you know, this is the reason why every day as you talk about it, you notice we started, Toby, when the real estate agent joined your home sold guarantee, we start the charitable, we start with $50 every time they close escrow, but that's not, the goal is that for you to be a millionaire real estate agent, and Toby already gave a little secret right there, once you hit the millionaire real estate agent, Toby is gonna help you to set up your own nonprofits. So can you imagine, that's the vision, you guys. 5-10 years from now, every single one of you will basically you control your own nonprofits that's dear and near to your heart. But because of time, Toby, if people have questions, what's the best way to, some people cannot even get to your link here.
I know you guys probably broke the link. No, keep trying. It's sometimes it's but the p.andersonadvisors.com, you can reach out, or just reach out to, everybody else says it's working. Or you can just reach out and say, hey, Rudy, I can't get a hold of him. He'll just send
No. Okay, that's the email right there. Don't email me.
Call Rudy, preferably after midnight on his cell phone. No, I'm just kidding. P.Anderson Advisors.
No, Toby, you have to call and text consistently from midnight until 3 a.m. Then he'll answer.
Okay, Toby,
Guys
we
just
gotta
don't know
go.
the secret.
Or just
I
drive
have
by
a
his house and honk.
Yeah, Toby, thank you for always helping everybody here at your home sold guaranteed realty to save money, keep money, and asset protection, man. Once you guys start making money, there are a lot of bad lawyers there. They just want to take away your money, filing frivolous lawsuits and stuff. So that's why working with Toby is part of our system here, right? There's no use, there's no point of making money, and then somebody's just going after you.
Yeah.
And Trisha, look at Toby. Trisha, man, your first client's there. She's a brand new agent. In the last 90 days, Toby, making over 100,000. She needs you, man.
Who
She
did
needs you
that?
like last week.
Which one did that?
The one that trying to book an appointment to you, but
Oh, yeah,
but your
I
people put her on February.
Sorry,
No, February, man. She has to pay. I think her tax bill now is like she almost collapsed now.
Hey, taxes are like it's like the hot stove. You only touch it once.
Yeah,
And then you're like, crap, that's hot.
Trisha used to be a dental hygienist. Her tax bill now, Toby, I think it's more than her salary when she was a dental hygienist. So anyway, Toby, we gotta go. Thank you so much, everybody. Have a good day.
All right, thanks, Rudy.
Thanks, Toby.